Apple announced its 4-for-1 stock split and its share price jumped 25%. Tesla stock jumped 40% and has surged past the $2,000 mark after it has announced its 5-for-1 stock split. In this video, we will be looking at 7 potential companies that may be ripe for stock splits. My name is Arshad Ahmed and I'm a founder of DIYstockpicker.com, an investing portal providing market news and analysis of companies in the stock market. Stock splits the new trend among companies, and is that a good strategy to invest? Which are the 7 potential companies that may be announcing stock splits soon? Please stay until the end of this video to find out. So what exactly are stock splits? All the publicly traded companies have a set number of shares that are outstanding. A stock split is the decision by the board of directors to increase the number of shares outstanding. For example, in a 2-for-1 stock split, 1 additional share is given for each share held by the shareholder. Say for example, a company has 10 million shares that are outstanding. In a 2-for-1 stock split, after the stock split happens, the total number of shares outstanding becomes 20 million. A stock's price is also affected by the stock split. The total number of shares outstanding have increased, so the price of the stock decreases. In an example of a 2-for-1 stock split, the price of each share will become half, since the number of shares have doubled. But the key thing to understand here is the market capitalization of the company is not affected. So what is the market capitalization? If you take the number of shares and multiply it by the share price, then you get the market capitalization of the company, which is the aggregate valuation of the company. The primary reason for splitting stocks is done by companies that have seen their share prices increase to high levels, or at least to levels that are higher than the prices of similar companies in their sector. The primary motivation of splitting a stock is so it becomes more affordable for the smaller investors, even though the valuation of the company has not changed. And this ends up increasing the liquidity in the stock. And after a split happens, the share prices increases after the initial decrease. And there are 2 reasons for that. The first reason is, since the stock is more affordable to smaller investors, they end up buying the stock and they drive up the demand, thus increasing the prices. And another reason for the price increase after the stock split is that a signal is sent to the market that the share price has been increasing, and investors will assume that this growth is going to continue in the future, and then they end up increasing the demand for the stock, and thus the price increases as well. Amazon, the e-commerce giant, has come a long way since it became a public company in the year 1997. In the past 5 years alone, its stock price has risen from around $500 a share to the current $3,300 per share, for a 6-fold increase. Behind this rise, the whole retail sector has stumbled and many of the iconic companies have gone bankrupt. Amazon stock split 3 times in the past, and all this happened before the 2000 market crash. 1 share at IPO would be 12 shares after all these splits. Now, with no end in sight for the rise of Amazon, this may be a good time to announce a stock split. Come to think of it, if you had to invest $3,000 for a single share of Amazon, it's not very accessible for the retail investors, because that becomes a major chunk of the paycheck for most of the people. Jeff Bezos, who is the CEO of Amazon, is a very shrewd manager and an investor. In his first annual report, he has laid out his investment philosophy. And this is tailored on the value investing principles of Ben Graham and his famous student Warren Buffett. He has promised to stick to a long-term approach, and he has promised to create value for the shareholders and ignore the short-term gyrations in the market. With such a solid investment philosophy, it would be very interesting if the Amazon stock split. On a side note, Warren Buffett never split his Berkshire Hathaway Class A stock, and each single share costs more than $300,000, which is more than the median house mortgage. He has done so that only people who have a long-term vision invest in his company, and he has done so as to keep the day traders away from trading his stock. Another company that belongs to the trillion-dollar club is Alphabet, which is the parent of Google. With a 150% return in the past 5 years, this was one of the stocks that contributed to the bull run of the current stock market. If you look at the stock split history of Google, its stock split in April 2014. And there is a reason why the stock split. Before the stock split, there were two classifications of shares. Class A shares, which were distributed to the public, and Class B shares, which were held by the founders Larry Page, Sergey Brin, and other directors. When the split happened, a new classification of shares, Class C, was created. But Class C shares have no voting rights. And after the split, each Class A share has 1 voting right, and each Class B share has 10 voting rights. And this was done so the founders would retain the voting rights for the company. If you come to think of it, technology companies, the vision is set by the founders. So it makes sense for them to retain the voting rights. Now the stock price has risen so much that there is speculation whether Google stock will split now. However, Page and Brin have stated that they have no interest in having people who would like to make a quick profit out of the Google stock. They would rather prefer investors who share the interest in Google's vision. Since Page and Brin now have retained most of the voting rights, and another stock split does not seem likely. Starting from a price of $25 and reaching $1,000. Investors who were part of this journey have seen outstanding returns from Shopify. Shopify helps businesses by providing them tools to start, grow, and market a retail enterprise of any size. Merchants can use its tools to run their business across all their sales channels, including web, mobile, social media, and the physical marketplaces. With the pandemic closing most of the brick and mortar businesses, it provided the tailwinds for Shopify, and it has cashed in on this trend. In 2019, Shopify had a revenue of $1.5 billion. In the second quarter of 2020 alone, it has raked in $715 million. The market capitalization of Shopify is currently $220 billion. It still has to report earnings, but by non-GAAP measures, it is already profitable. But the excitement is about the future. Shopify is often compared with Amazon in its early days. Both of them are e-commerce leaders. Both are growing their revenue at a rapid pace. Both power enormous amounts of vendor sales. Amazon has joined the trillion-dollar club, and many investors are optimistic that Shopify would do the same. And if that happens, with the current share price, it will be a 5x return. And the price rising to such levels, it may make the management think about splitting the stock. Regeneron Pharmaceuticals is best known for its tremendously successful eye disease drug Eylea. It also partnered with Sanofi to market Dupixent, which further soared its sales. It also has biotech drugs in late-stage clinical trials, which are used for cholesterol and Ebola antibody therapy. However, the excitement is about its latest COVID-19 antibody drug. This is what has propelled its share price from $450 to $600 in the past 3 months. With the coronavirus pandemic, investors are boosting up the share prices of the pharmaceutical companies and biotech companies which are involved in the research for a drug or a vaccine. Regeneron Pharmaceuticals has partnered with its rival Roche to help it market the antibody drug. It has done it so that it could reach a global market more quickly. After the regulatory approvals happen, it can more than triple its supply of the drug, and it can provide a further boost to its current share price. Netflix is the granddaddy of movie streaming services. With the vision of the future of cable and movie watching and the capability to execute its vision, Netflix has come a long way. It is said that its CEO Reed Hastings got the idea for the company after he had to pay late fees on his movie rental. However, this claim has not been validated. When it started, Netflix was purely an original DVD rental company. Users could order movies on their website and ship them back in the envelopes provided after watching them. This was a boon for those people who did not have a movie rental store nearby. Netflix went public in 2002 and only in 2007 did it start to pivot towards a streaming model. With the app available in Apple, Nintendo and PlayStation devices, the company took off. After its original content and many academic awards later, Netflix grew into a subscriber base of 190 million subscribers in 190 countries. With a market cap of $213 billion and a revenue of $20 billion, Netflix is poised for further growth. In this heated market, each earning report is driving up its stock price. Adobe, which is the maker of blockbuster graphic design and creative products, was on a decline. It had only desktop-based software to show. The company then executed a transition from its desktop licensing model to its current cloud-based subscription model. Its offering of Creative Cloud offers a complete suite of products in the cloud for graphic design, video editing, and document authoring. This was just the boost it needed. Its stock price has risen 6 times from $80 a share to its current $470 a share. Its revenue has doubled from under $6 billion to above $11 billion, and the net income has doubled from $1.5 billion to $3 billion. After Microsoft and Oracle, Adobe is the third valuable business software company. With a market capitalization of $220 billion and the market not shying to give trillion-dollar valuations, Adobe sure has a lot of runway left to grow. Domino's Pizza stock grew 210 times from $2 a share in 2010 to the current $420 per share. They have achieved this growth by really listening to the customers and honestly changing their core offering, which is their pizza. Until 2010, they were a great pizza delivery company with a terrible tasting pizza. Patrick Doyle joined as the CEO of Domino's Pizza, and he spearheaded a transformation of overhauling the complete pizza recipe, using fresh ingredients and having a completely new crust. Nowadays, ordering pizza using mobile phones is the norm, but Domino's was actually the company that pivoted and spearheaded this transformation. They produced the app where users could order their pizza, and they gamified the process by providing a virtual pizza builder where users could add their toppings on their screen. And they even added the delivery tracker where users could exactly see where in the process their pizza is. They took the delivery game to a whole new level using zero-click ordering. They even use self-driving cars for pizza delivery and experimented with drone delivery as well. With the revenue of $3.6 billion and a market capitalization of $16 billion, Domino's has a lot of room to grow, especially since it's not just a pizza company but a pizza delivery disruptor. With the stock price at new high levels, this may be a time for a stock split, especially since it will be easy for the retail investors to invest in the Domino's stock. That way, they can savor the stock as well as they do their pizzas. How to invest in the stock splits? Is it a good strategy to invest in companies thinking they will split their stock and the price will go up? I don't think it's a good idea. The only reason the price of a stock goes up in the long run is because of the earnings a company produces. The rest of all is speculation. It is better to look at companies that have a good business model and that are producing consistent earnings and invest in them rather than investing in companies thinking they may announce stock splits. The companies that we have discussed in this video have grown because they are quality companies producing shareholder value. And those are the kind of companies that you should be researching and try to find them early so that you could be part of the journey of the outstanding share returns. I'm a founder of the portal DIYstockpicker.com and I send out a newsletter every week with investing strategies and market news. This is free of service. I will put a link in the description below. So make sure that you sign up for this newsletter. If you like this video, please hit the subscribe button, like this video, and hit the bell button for notifications. I will be releasing videos every week. And please make sure to leave comments below if you have any interesting ideas for the videos or if you want an analysis on interesting companies. Thank you for watching.